Well, good afternoon. Happy Friday, August 9th. Mark Milam here, your mortgage professional. Let's get right to it this week. So lots of activity this week and lots of calls, texts, and emails about interest rates. Everyone asking how low have they gone? Is it time for us to refinance yet? How much is it improved for my loan that might be in process? And let's talk a little bit about what's unfolded since last Friday. So last Friday, we got the non-farm payrolls report, which showed that we added fewer jobs than anticipated. And simultaneously, the unemployment rate ticked up from 4.1% up to 4.3%. That sent the stock market into a tailspin that rallied mortgage-backed securities, which helps improve mortgage interest rates. But ever since then, starting on Monday of this week, we've been giving a lot of that improvement back. Let me show you what I'm talking about. We take a look at the candlestick chart. This is Monday of this week right here. Remember, red days are bad days. Those are the days where mortgage-backed securities are selling off and interest rates are worsening or going higher. And we can see on Monday, we gave back some of this improvement we got on Friday. Tuesday gave back more, Wednesday, Thursday, to the point that really all of this improvement that came on Friday had been returned. And then here we are on Friday, a relatively flat day in the world of mortgage-backed securities. Why is this happening? Well, we got the weak labor report, and as markets tend to do, whether it's the stock market or the bond market, as markets tend to do, it's a little bit of an overreaction. Listen, it was one report, right? And then over the course of this week, which is a relatively light week on the economic calendar, we got some data that might suggest, hey, listen, jobless claims are not that high. Manufacturing looks pretty strong. Perhaps we've been a little overzealous in our anticipation that we've got a really weakening economy or a weakening labor market. And so some of these gains have been pulled back. Listen, the overall trajectory is good for interest rates. We have been heading lower as the weeks progressed, just not quite as much as people think. And Freddie Mac isn't helping the situation. Listen, Freddie Mac reports a weekly survey of interest rates. Of course, interest rates move each and every business day, but Freddie's survey is based week to week. So they take a measure once per week, then report it out, and they compare it to last week. And this survey is taken on Thursday, which presents problems. And let me show you what I'm talking about. This is the actual interest rate curve here, the blue line. This is what's been happening with mortgage rates. And you can see some of this give back that we've had this week where interest rates have had a little bit higher. The orange line is the Freddie Mac weekly survey. And you can see that this time last week, boy, they really missed it. They didn't realize how much things had improved because all of that improvement happened on Friday, and Freddie Mac had already posted their weekly survey on Thursday. So they missed out on last week's improvement in their report. And simultaneously, while they're reporting much lower rates this week, the market has actually worsened a bit, and they're missing the mark again. As a matter of fact, the headline of this article is, "No mortgage rates are not lower this week," even though you might find headlines like this around the internet that state that mortgage rates have plummeted to the lowest levels in over a year. This is just a timing thing with Freddie Mac, and unfortunately, the way that the market data came out on Friday of last week just missed that Freddie Mac Thursday cutoff. So it's created a lot of confusion with referral partners, with clients, and with the media in general. Let's talk about the next Fed meeting, which is coming up on September 18th. And everyone's asking the question, hey, are interest rates going to get even better? Mortgage interest rates in particular are going to get even better when the Fed cuts the Fed funds rate on September 18th. Well, it's not a foregone conclusion that the Fed is going to cut the Fed funds rate, although most people believe that they will. But even if they do, we're likely not going to see a substantive improvement in mortgage rates from here. See, the bond market is trading mortgage-backed securities each and every business day, and it moves in advance of what it thinks will happen. And because it also believes that the Fed is going to cut the Fed funds rate, a lot of the improvement that we have seen over the past week is really coming in anticipation of the Fed funds rate cut. So I wouldn't anticipate that we'll get to September and see something dramatic or see something largely different than what we've been experiencing over the past 7 days. But still, we are in uncharted waters as it pertains to our economic climate. What do I mean by that? You might have seen reference to the Sahm rule or the inverted yield curve, all of these predictors of recession, yet here we are still, our economy not in a recession. And I'll just say, we have more homeowners that are locked in on historically low rates with incredible equity in their homes than we've ever had before. And of course, because that's most people's largest expense, that frees up other income for spending, which is stimulative, right? It's inflationary to have all of that other income to spend. We also have government spending that's akin to the pandemic or World War II. In other words, the government is spending at levels that we've only seen a couple of times in our history, whether that's World War II or during the pandemic. That in and of itself is also stimulative or inflationary. We're also on the front end of a forever labor shortage, as it's been dubbed by the U.S. Chamber of Commerce. We have about 11,000 people per day turning age 65 and moving into retirement, which is going to create a bit of a labor shortage that's going to last for quite a long time in the United States as the baby boomers hit retirement age and move out of the workforce. That's something we've never witnessed before in the history of our country, and it's going to be interesting to see how it unfolds. And of course, the pandemic that we all lived through changed behaviors, right? We have less personal savings. We have more remote work. There's the phrase quiet quitting that I'm sure you've heard. As a country, we have fundamentally changed, particularly with our labor force. We also have a record deficit that we've never seen before in the history of our country. So many variables that have never come to pass, especially at the same time, that when you get into the world of predicting what's going to happen, especially as far out as September 18th, you really are going out on a ledge a bit. It's going to be week to week, data dependent in terms of what happens next. Speaking of that, so next week, and I'll close with this, we get the producer price index and the consumer price index. These are largely regarded measures of inflation that are going to have an immediate impact on what happens to the trajectory of interest rates. If we start to see inflation ticking back up, you can expect mortgage rates to worsen. If we continue to see and beat estimates to the low side, meaning we start to see inflation really moderating beneath expectations, well, you might see some improvement in mortgage interest rates. It'll be interesting to see how that unfolds on Tuesday and Wednesday of next week. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.